Let's talk to Craig Erlam. He's the senior market analyst at OANDA. Very good morning to you, young Craig.
Good morning.
Obviously, being a scouser, you're very, very happy this morning. So let's move swiftly on and talk about the stock markets. You sent a chart today, the US dollar against the CAD. Why did you choose this market?
I chose this market because I wanted to sort of look at a dollar pair for one. There's a lot of US news out right now, be it trade wars, be it Russian sanctions. There's also data today. We've got the US CPI data.
Okay.
We're expecting an uptick in inflation, which is going to, if it materialises or if it beats, could be quite interesting from a central bank perspective. And then staying on the central bank, we've got the FOMC minutes tonight. So I think the dollar is going to be a very key focal point for traders. It always is, let's be honest. But I think today the dollar is going to be quite interesting, given the data, the minutes we have out, etc. Looking at the pairs, there's not a lot of volatility. There's a lot of choppiness, but not volatility, trend volatility in a number of the pairs right now. That's why in recent weeks I've been talking a lot about the yen, because that's one area where we have actually seen some nice trends, but I thought we'd have a break from the yen this week. And the dollar CAD pair is just looking quite interesting right now. You could say that it's range bound, and it is, but at least we're seeing some notable breakouts, which is giving us something to look at. So right now, we looked as though we'd broken high, right? You can see the two red moving averages there, or the 200 and 233-day simple moving averages. We broke below there back in June, and we've trended below there since, finding resistance on there once or twice in the meantime. We broke above, and it looked as though this was a very nice bullish move for the pair. We then took out the previous highs. Again, another bullish confirmation, so suddenly things are looking very positive. That didn't last very long. We had immediate turnaround, looking around the kind of 132 levels. And next thing, we've got this kind of head and shoulders pattern. Now,
which is a bearish formation, isn't it?
Which is a bearish formation when you get a breakout. You can see the left shoulder formed just before the peak. The head is the peak itself, and the right shoulder formed around the same level as the left shoulder shortly after the peak. So the neckline really is that low that we hit in between, just before the peak and just after the peak, which comes in this case at around the 128 level. We broke below there, which is a very bearish signal. That gives you two possible price projections. One is from the shoulder to the neckline projected below, and the other is the head to the neckline projected below. The shoulder, the more conservative projection, was hit at around the kind of 126, 126.50 levels, which, as you'll see from the chart, was also long-term support and resistance on a number of occasions. So while we are range-bound really here between 123, 122 and 130 in the longer term, you've got this 126 level in between where we repeatedly hit support resistance along the way, and a break of that level can be, or has been, a decent indicator that we're going to move back to the other extremes of this trading range. So this is where trading ranges can be quite interesting.
The key thing is you've had a short-term sell signal on the head and shoulders with the downside objective, because it gives you a downside target, and that target's been reached. So that bearish pattern is now negated, or could it go lower because it's a minimum target?
So it's hit the what I'd call a conservative price projection, which is shoulder to neckline. The more aggressive price projection is the head to the neckline, and that would take us back towards those kind of 124s, 124.50s, which coincides very nicely with prior support as well. So the fact that we've seen a break of that 126, 126.50, so previous support and resistance, for me is additional confirmation that this is still quite bearish. This would look to me like I'd be right now. I think 124, 124.50 is a very possible, a very achievable level for this pair. And then after that, that's when you say that then negates the head and shoulders, the projections being completed, and then you're looking for other signals. So at 124, 124.50, I'll be looking for signs from the momentum indicator at the bottom that maybe this sell-off has run its course. Of course, we can come a little bit lower. The most recent low was around 122. Looking behind that, you've got around 120. So now I'm looking for signs that these 122s, 120s are potentially going to be hit, or, as we've seen on a number of occasions, 124 potentially holds, and we stay trading in that 124, 130 range. And a lot of markets right now are range bound, and for a lot of people that's perfectly good. That's what they like to see. I prefer to see upward and downward trending markets, but this is I think a good example of a nice range bound market. The spread is quite wide from 124 through 130. And there's nice, clear support and resistance levels, giving you indications along the way. We're back below the 200, 233-day simple moving average band. Perhaps that's a sign that we are back in either range bound or back in bearish territory. But in a sideways trading market, I tend to pay less attention to those momentum indicators. I paid attention to it last time because we broke back above, which was the bullish sign. We'd seen resistance, but now we're back choppy territory again.
On that note, Craig, thank you very much. Well done to your football team.
Thank you.